Have you been fighting those lousy trading algorithms? Does it just seem like they got you by the balls? That every time you go to buy, the price is a little bit higher than you intended? Or when you sell, it's a little bit less than what you thought it was going to be? Well, you've come to the right video, because the knowledge presented here is going to be
worth every penny, bro.
Hi there, welcome to the channel. My name is Mike. Here on this channel, I like to give you more information about different things. But before we get into today's topic of order types too much, I do need to do some channel identification because the higher ups that be have instructed me to do so. What the heck is this? Anyway, here on this channel, I like to give you more information to hopefully make decisions in your personal financial journey a little bit easier, or at least more well-informed. I am not by any means any kind of professional. I can't tell you what to do with your money, but hopefully the information that I present to you will help you make better decisions. If that interests you at all, think about hitting the sub button or the like button on this video. I do appreciate it. Anyway, let's talk about order types. Well, when it comes to trading on the stock market, there's basically a conversation being had between you and your broker. And it goes a little something like this.
Hello, Mr. Broker. I would like to purchase 10 shares of this stock. Oh, well, hello there. Yes, that's very good, very good. And how would you like to purchase these? Yeah, with this account. Aha, I see. And how would you like me to purchase them? How? Don't you do that? Like, what do you mean?
That there is an order type. How'd you like my TikTok, filming skills, the conversation back and forth? Not too shabby, eh? Focus up. All right. So there are 3 different order types. Basically, these are ways that you interact with your broker, right? There are market orders, limit orders, and stop orders. Each have their own positives and each have their own reasons why you should never use them. Looking at you, market orders.
What did I do?
So with that, let's go ahead and look at market orders and how they work. Because this is the most basic type of order. It's basically telling your broker that you need to get those shares any and all ways necessary. Just keep giving me more and more.
Give me another one. Give me another one.
This can make the price that you pay much more than what you expected or what you intended. Basically, you're just telling the broker that at any price available at whatever the market dictates, you're going to accept that price. And then you just grab these different shares from the open market. So in the process of utilizing a market order, let's just do an example where you're trying to buy 5 shares of a stock priced at $5. Now, there is the possibility that you are able to buy those shares with a market order at $5 and you spend $25. But there is also the opportunity in which that market order doesn't respect that $5 price and the market dictates that now the shares are worth $5.50. You now are spending $27.50 to get those 5 shares, in which you're making more of 200. You're spending more money than you intended of that $2.50. But that's the way you've told the broker to go get those shares. Just give me more. Give me another. Give me another.
Give me another one. 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 Give me another one.
Shut up, Peter. All right. So you paid $27.50, which is $2.50 more than what you intended. And I know $2.50, woo, break the bank, right? But let's just do a different example, right? Let's say you put in a market order to actually buy at $5 a share while a stock is halted assuming extreme volatility. All right, and let's just say that stock decides to open at $10 a share. Well, with your market order, you told your broker just go get it at whatever price is out there. And so you go and spend you get 5 shares at $10 a piece. Now it's $50. You've now spent double what you intended to, right? 25 now became 50. That's a tall order. And let's just expound it, right? Maybe it's 10 or 100 shares. It just compounds so much the larger and more money that you're putting out inside of your market order. Now, to be fair, there is the option of it being the reverse, right? That halt made it go from $5 to $2, and now you're only paying $2. But that is not something you need to worry about or chance, because when it comes to limit orders, there's something in place that will actually get you that better price anyway. So with that, let's just move into limit orders, right? These are going to be your bread and butter. This is basically telling your broker, hey, I want to buy these shares, but I only want it at this price. It dictates that you want that price and only that price alone. And you're telling your broker, listen, you buy it at this price
Or else.
and I swear if someone in the comments decides to comment on how I look like that guy. Anyway, limit orders. The setting of the price lets you have ease of mind that you will not pay more than what you intend to pay. But you can be rest assured that if it comes to where the price is lower than what your limit price is, the SEC has Rule 606A of the Regulation National Market System, in which broker dealers must provide quarterly aggregated public disclosure of their practices in the routing and handling of held orders, requiring prompt execution at the best possible price. Basically stating that the broker must give you the best price that's on the market at the time of your execution of your order. So when you say something needs to be $5 and it comes out that it's actually priced at $2 or people are selling it at $2, they must go find you stuff at $2 to be able to purchase. By golly, doesn't that sound good? And with that, those two market orders are pretty self-explanatory. Now that you know, market order is just buy the wind, whatever's out there, grab, gimme, gimme, gimme. And then limit price is basically saying, I want to buy it at this limit, that's what we want, or I want to sell it at this limit, that's what we want. And your broker has to do what's best interested in your situation. So you either sell at this price or higher, or you buy at this price and lower. Now this brings us to the last order type, which is a stop order. Again, now a stop order is really great for a set and forget type of style of trading. Basically, you're wanting to tell your broker that if something happens in a certain situation of a 5% decrease, 5% increase, whatever it is, that you're stopping out and you want to either capture those gains or avoid those losses. Different brokers will handle these in different ways. But basically the biggest part is that you're setting these orders, and then once the price hits that certain area, you're selling, and the broker just has the opportunity to sell without you having to constantly maintain. It's a good way to alleviate stress and not have to watch it constantly or all day long. It's pretty good for a lot of different scenarios, especially when it comes to trying to manage your entire portfolio and you have multiple trades across multiple things. Don't really advise that for anybody doing beginner type stuff, but it is a way to be able to ensure that the action that you wish to take is executed, even though you're not having to actually, actively watch that certain scenario play out. Okay, so with that, different types of stop orders, right? There is a stop loss or a sell stop order. This will ensure that if a price were to drop an X amount of percent, it goes ahead and sells your shares so that you don't keep losing money. In the same way, if you determine that a stock is going to go higher after reaching a certain price, you can buy in and keep riding that wave up if that's so how you determine. That does get into more, sophisticated strategies in the sense of looking at, volume shelves or different resistance levels and all that sort of stuff. These are more technical analysis type terms. We will actually talk about those in a later video. But just know that there is the opportunity to buy at certain levels or sell at certain levels. Now, there is one cool thing that I do want to throw out there in this video, and it's called a trailing stop loss, in which the actual stop loss will move with the stock as it goes up. This is fantastic and awesome. So basically, let's just give an example here. You bought a stock at $5, right? And you want to make sure that you get stop lossed out at 5% below that, which would be $4.75. Now, if the stock were to actually drop to $4.75, your broker's going to sell and get you out of there. But what happens if the stock rises to $6? Right? That's like a really big jump. You wouldn't want to sell at $4.75 now. You'd probably want to sell at something higher, right? If we have a trailing stop loss order, it will actually move with the stock as it moves up, and it just keeps rising with it. So when you get up to 6, the trailing stop order that has a 5% trailing stop is now valued at $5.70, right? 5% below $6 is going to be $5.70. Yes. I had to redo my math. So now that your stock is valued at $6, you want to ensure that your stop loss has gone up to 570. And there is a order out there called a trailing stop loss that will go up with your price as it goes up. This means that your investment at the $5 is now going to stop loss at 570. This is really, really powerful in the sense of making sure that you ensure your gains, or you take your gains when they're there, because as the stock starts to dip down, you can actually get stop lossed out, and you've now made 70 cents a share. It's a profitable trade. This is why I'm saying that there is the opportunity to set and forget. As the stock moves, it will either protect your money from being lost, or it will ensure that you have profits because it's risen so much. It's really nice. I understand that it seems really simple and things can be really profitable. It's like, oh, obviously every time I buy, I just set a trailing stop loss, and then when it drops down, I've actually gained money. Doesn't always happen that way. It's not the perfect system, but it is a nicety to, like I said, be able to set and forget. If you've bought something, it moved up pretty high, and then you put in the trailing stop loss, you basically are saying, I'm going to keep these gains, but if it keeps going higher, then I will continue to get those gains, or get more of those gains, until it decides to drop back down. Okay, so like I said, this is not exhaustive in the list of different ways that you can utilize these orders to actually have good trading strategies, but just know that there may be some more sophisticated ways that are out there that you can go find in order to utilize these different order types to make a great trading strategy. Coupling these with things like technical analysis, volume shelves, trying to indicate how this behavior of the stock is going to occur, are just great ways to try and set yourself up for success. So hopefully you've learned a few things about what these different order types are, how to utilize them. They're things I use all the time. I do appreciate you watching all the way to the end of this video. If you would, hit that sub, hit the like, all that sort of stuff. I just try to bring more information to light for you so that you can make better personal financial decisions. If you win, I win. If we all win together, things are great. And that's what I was hoping for this entire channel. So if you want to follow along, thanks for sticking around and hit that sub, all that good stuff. As always, I hope you have a wonderful rest of your day, and I will catch you in the next video. Goodbye.